Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to foreign currency borrowing and effective interest rate. Get ready, it's time to take your chance with Corporate Finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. What we're going to be using is the effective interest rate. We're going to be calculating the effective interest rate on a borrowing money in a foreign currency. That'll help us to standardize the effects of borrowing money in the foreign currency, which means, one, we have the interest we would have to pay on it, but also we have the change in the value of the foreign currency in relation to the US dollar. Here's the scenario. US company borrows in foreign currency because it is thought that the interest rate is lower in the foreign currency. So we're going to say, let's borrow within the foreign currency because we think we have a better interest rate to do so. Interest rate 8%. We're going to say it's 1 year loan, so it's going to be a straight 1 year loan. During the year, the dollar falls against the foreign currency by 10%. So that's the other thing we're going to have to be taking into consideration because we're going to be recording our books in US dollars, and we have to think about what the change will be with relation to the foreign currency. What is the effective interest rate on the loan for 1 year? So to think about this in a little bit more concrete, we can think about this a little bit abstractly by just looking at the rates. If we put an example on, just to think about it a little bit more concretely, what if we were to borrow 155,000 yen? And this isn't the actual exchange rate, but let's assume that we think of the U.S. value of it at that point in time being 100,000. In other words, possibly we borrow 155,000 yen, and then basically we get the money in yen, and we can then think about exchanging it at that point for 100,000 US dollars. 100,000 being equivalent to the 155 yen. Now, when we're going to have to pay the interest on it, we're going to have to pay the 8% of the 155,000, or we could think of it as the US dollar equivalent, 8%, of the US dollar equivalent. But we're also going to be having to deal with the fact that the relative rates between a foreign currency and our currency will change. And we can think about this just like anything else. If we were to invest in yen, take some of our money and just put it into the bank account, and buy yen, if we were to buy yen, right? And now we would be holding on to yen. In that case, you would think about it as any other kind of investment, or you could think about it as another kind of investment. Just like if you had stocks or bonds, you would then have 155,000 units of some other thing, which happens to be a foreign currency, which would be valued in US dollars at the 100,000. In this case now, we're saying that we borrowed the money and we owe back 155,000 yen. And we have basically, US dollars. So we've got US dollars, we've got to pay back 155,000 yen. Now, at the point in time that we took the loan out, that was worth 100,000. But during the year, the dollar falls against the foreign currency, meaning if the dollar falls, it takes more US dollars. The dollars got weaker, so it would take more US dollars to be paying off the same amount of yen. So that means that if it's a payable, if we're paying back in the foreign currency and the US dollar got weaker, now we're going to have to pay back more in the US dollar in order to pay off the 155,000. So that basically acts as if it's a kind of like a loss. That's when we can think of it basically as more interest when we think about our effective interest rate calculation. So in essence, we can think of the total cost to us. We can say, all right, the total cost to us is obviously we have the rate of interest that we're going to be paying is 8%. So we're saying it's going to be 8%. We're going to say home tab number group and 8%. And then we're going to have to say, well, also what happened is there was a fall in the US currency compared to the foreign currency, which is going to be bad for us because now it's going to take more dollars to pay off the loan that's in the foreign currency. So that's basically, we could think of it as an increase basically to the interest rate of the 10%. Home tab numbers percent. I'm going to say home tab font group and underline, and then we can say the effective interest rate then, if we were to add those two up, would be equal to the sum of the 8 and the 10, or I'm going to go home tab font number group and percentify that. We've got the 18%. So let's work that out with our example down here to make it a little bit more concrete. Now there's a couple different ways you can calculate this, But let's assume that we borrowed the 155,000 yen, we converted it to basically dollars, and you know, used it for our purposes, right? And then we're gonna have to pay back the 155,000 yen, right, at a future date. Well, what are we going to have to pay back? Well, there's going to be interest on the yen, which we can calculate in yen, but we can also calculate the basically the US dollar equivalent. So we're going to say, all right, let's say the effect of the interest. We're going to say the interest colon is going to be the loan. I'm going to do it in dollars. Notice we could calculate it in yen and then use the exchange rate at the end of the day, but I'm going to calculate it in dollars. If you want more examples of this, you can take a look at the, we have a course in advanced financial accounting that gets into more of these types of transactions in more detail. But just to get an idea of this, we're going to say, all right, we've got the dollars, the US equivalent dollars. This is what we would have to record the payable on our books, the 100,000. And then we're going to say that the rate of interest is going to be the 8%. So we got an 8% interest rate. So I'm going to percentify that by going to the Home tab, Numbers, Percentify. Then we're going to go Home tab, Font Group, and Underline. And that's going to give us the interest. Interest. Now, obviously, the interest would be due in yen, the foreign currency. But we're going to assume that the relationship would be the same. So basically, the US dollars would go 8%, right? 8% cost to us would be the 100,000 times the 8%. And I'm going to indent these. I'm going to select these three items, Home tab, Alignment, increase the indenting, and then this one, Home tab, Alignment, and then increase the indenting. Now we also have the cost of the foreign currency compared to the US dollar changing. And that's going to be the other factor we need to be taking into consideration. And that's going to be, let me do it this way. Well, that works. And then, so this is going to be the loan, once again, in US dollars of the 100,000, and then we're going to say that there was a decline, and I'm going to say this is going to be the rate rate of fall in U.S. currency compared to the foreign tax. So the U.S. dollar declined in comparison to the foreign currency by 10%. So Home tab percent. So that means it's going to take more dollars that we have to pay back. We have a payable or a liability on the books now, which would have cost us the 100,000 to pay off the principal, which was 155,000 yen, but now it's going to cost us more because of this change in the rates here. So I'm going to say Home tab, Font Group, and Underline, and this is going to be, we'll call it once again, the fall in U.S. currency compared to the foreign currency. This is going to be equal to the 100,000 times the 10%. We're then going to select these three. I'm going to go to the Home tab, Alignment, increase the indenting, and then here, Home tab, Alignment, increase the indenting. I'm going to underline under this 10,000, Home tab, Font Group, and Underline, and this will give us the effective interest. So this will give us the let's call it the effective interest total, right? And this is going to be equal to the sum of these two. Now, I'm calling this basically effective interest. This wasn't technically interest, right? This was the cost of the fact that the US dollar just became weaker compared to the yen, therefore taking more US dollars to pay off the yen. But the effect of it is still the cost of the loan, and we're trying to equalize the interest here that we might be paying on this loan compared to, say, another loan. We're trying to standardize the two things and see what basically the cost of the loan was. The cost of us taking out the loan wasn't just the interest rate that we had to pay on the loan, but also this change that took place. And then we can recalculate the effective interest rate again. So we can say the total effective interest rate then is going to be equal to the 18,000, the total cost of the loan, divided by the loan amount in US dollars, because we did this whole thing in US dollars. We're going to say Home tab, Font Group, Home tab, Number Group, percentifying it, and there's our 18%. Is it even? Yeah, it's even. 18% once again. So this is a little kind of proof of the calculation you could do up here in a little bit more abstract a way. Notice we can do this by calculating this in yen. If you were to take a look at this and say, well, we would have an 8% return in yen, and then think about the current exchange rate and whatnot to see the gain or the loss. If you want more on the calculation of foreign currency transactions and how you would record them, then once again, take a look at our course in advanced financial accounting.